Montana. We're doing a lot of that in Florida on an E&S basis, especially because a lot of the, maybe at a million or a million one, there's a lot of admitted markets that just aren't playing there, or they aren't wide open for new business. So we're winning markets like that. Coastal South Carolina for sure is a huge market. We're one of the largest market share players along the coast in coastal South Carolina, certainly writing more new business than most, if not all, of the rest of the market. So there's a number of markets where those are big for us.
Welcome to Insurance Shoptalk. This is the podcast where the world of commercial insurance gets a little closer to home. I'm your host, Eric Stein, and in every episode, we're taking a deep dive into the insurance industry, from the latest news and trends to in-depth interviews with insurtech experts, carriers, and agency newsmakers. We're covering it all. So sit back, tune in, and let's start the conversation. All right, everybody. I'm excited to have Terry McLean here, the CEO of SageSure. This is a bit different than my norm in that we're talking more about the personal line side of the house. And so in the area of, cat risk for homeowners and insurance. And I know that's a big deal in a lot of the states maybe that you're operating in as agents. And it was good timing that Terry and I connected to go through it. Terry, how you been?
Great. Good to be here.
Yeah, I appreciate you coming on. So Terry, why don't you kick us off and tell us a little bit about your background and SageSure and sort of how, you got into the mix of in this side of the business.
Sure. Yeah. Well, to start off, unlike many of us in insurance, I wanted to be an actuary when I was 14. My dad was a journalist in insurance, wrote for the National Underwriter. For those of you who remember that publication, he wrote for them for 30 years. So I love the math side and ultimately thought I was going to be a pension actuary. Finished school and worked on the annuity side for a little bit and realized I liked the more action on the P&C side, and spent years in financial institutions, investment banking, a lot of technology. In school, I studied actuarial science, finance, and computer science. So the journey brought me eventually to starting up an organization. We were building a software and services company called Insight Catastrophe Group. Still have that, still around, have a number of clients. But we started SageSure in 2008 and ultimately wrote our first policy in 2009. So organically, SageSure has been focused on catastrophe-exposed property, really coming from the background of the underwriting mindset with catastrophe modeling focus. So that's been our home game. And we've grown this business to several $1 billion of premium organically. We've added some acquisitions in the last couple of years, but most of the business has been organically. And we focused on markets that ultimately have needed us. That's been, we've kind of, I don't know what the Warren Buffett phrase is, something like, be fearful when others are greedy and be greedy when others are fearful. And we've always taken a mindset that these markets need us. And when markets need you, the advantage is you can go into them if you know what you're doing and you can make a fair profit for what you do. And that's really hard as an MGU, a managing general underwriting operation that is built like ours. If you can't make your carrier margins, you're dead. You're gonna go by the wayside. We certainly don't build a good business by churning through market after market. So we've never lost the market. We've never been kicked out because we aren't making enough underwriting profit. And we've been able to grow to several billion by putting our money where our mouth is, investing in insurance businesses, but ultimately growing it as an underwriter focused on this business line. So that's been the journey. It's been a really rough last 5 years. The experience of catastrophes of all sorts, lots of hurricanes, severe convective storms, wildfires, knock on wood, no earthquakes, but it's been a tough couple years in the really 2021 through 2024 period. And we're really kind of emerging out of that now as reinsurance prices have peaked and are starting coming down a little bit. And now people are showing back up and chasing after the capacity a little bit more. So in 2025, the market is certainly looking softer than it did in 2024. In 2023, we were looking at what's this going to look like? How long is this cycle going to last? Not really sure, but one thing we were pretty sure of is 2024 will probably be the hardest property market of our lifetimes. Maybe that'll change. Maybe we'll see another cycle. But with reinsurance costs at all-time highs in 2024, we think that was probably the cyclical peak for a long time to come. So we're the
And I
trends.
didn't ask earlier, Terry, do you have any private equity backing or you just startup, just 100% yours?
Neither 100% mine. So we are more than 50% owned by management. Um, and I co-founded this, and my other co-founder, Brooks Clark, is our chief actuary and chief underwriting officer. We own the majority of that and are proud of our management ownership and broad employee base ownership. We do have outside investment. We have a large $1 billion credit facility with Ares, which is the largest private credit lender in the world. And we have outside investment from some of our partners. We have one private equity type partner, FlexPoint Forward. Ares did a little bit of equity along with the big debt facility they have with us. And then we have strategic investment from IAT Insurance Group and from Amwins. So those have been partners that we've had for a number of years. They're minority partners. They're great partners. We're quite happy with them. But we are luckily management owned and are allowed to control our own destiny.
That's
And
great. Yeah, keep the culture and decision making there. Um,
exactly.
and just have some bucks behind you. That's the best of all worlds.
Yeah,
Uh,
I think so. I think that's right. We were able to maintain our flexibility, and Brooks and I aren't inclined to sell. We love the business that we're doing. I don't want to speak for him, but I think we both are like-minded in our passion for the business and enjoy the game, enjoy the things that we can do, and find a lot of meaning and purpose in what we do. And so, um, I feel like I got a couple decades left in me, and plan to keep going for some time to come, and really enjoy what we're doing here.
well, it makes sense.
Having the
And then,
flexibility to not have to exit or go public or anything like that, that's certainly not in the cards for SageSure.
yeah, definitely the private equity groups are like a short leash of 5 years normally. So that's nice. You got that flexibility. Now, as far as like, why don't you kind of update us on, especially it's top of mind, obviously, because of what happened in the Palisades area in California with the wildfires there, and give us sort of an update of what other than the hard market, state of the union like California, Florida, what should agents be doing now to get ahead of the curve in general?
Yeah, so certainly tale of two states, California versus Florida, very, very different worlds. I live out in California in Silicon Valley, moved out here about 5 years ago because it's where my wife is from. And it's been interesting watching the California market. In spite of the 2017, 2018 big wildfire years and a lot of burning, and 2020 was a massive wildfire year, not quite as the major type events that you saw in 2017 and 2018. And then again, we've seen in 2025, but we had major wildfires, and truthfully, the market was not firm. The market wasn't firm at all. And you could have a lot of theories why, but the market started really turning in 2023. Maybe because State Farm started shifting their posture as new management came into place. Maybe it was that and other things. I can't tell you for sure exactly why it happened, but certainly the market turned in 2023. The market started going much more to an E&S market. If you wanted new business, certainly in the hills, people were almost exclusively going to the Fair Plan, and where people had significant wildfire exposure, it became incredibly difficult and incredibly expensive to find coverage. And where people were playing in the past, they weren't playing anymore. And so that kept playing out in 23 and 24. And then lo and behold, 2025, January, you have these massive, what seem to be, major changes in the market that we were expecting to come. Prices definitely moved up. They moved up quick in the E&S market. I'm sure most people saw, regulators push back on rate changes on carriers and ultimately capitulated a little bit. I would argue, not adequately. And I think it's going to be very difficult and take a long time for the admin market to get pricing where they need to get to feel like they can take any material wildfire risk. And sure, they could write houses, but are they really going to be able to write the most exposed wildfire risks? Probably not in an admitted rating environment. And what's interesting was we saw prices basically double within a few months in the E&S market, and in some cases way more than double. But across the market where we play, prices about doubled, and then what happened was very interesting in California, which is it sort of stabilized. Prices went up a lot in the E&S market because people can take prices quickly. And reinsurers reacted, but they didn't react at the level I would have expected. And I think the way most people would have expected. And renewals that had wildfire in them, they got done. And we were thinking that a lot of reinsurers would just say, we're done with this peril. And that didn't play out that way. So the market was quite orderly, and reinsurers were taking those losses in stride, which is a good sign and reasonable. If you believe that these are losses that aren't going to be happening every year, every 3 years, every 5 years, and you believe this is a once in a few decade type event, then they behaved normally and said, okay, we'll have to charge for this, and we'll probably have to charge more for this, but we're able to continue to take this risk. And so California, it has material distress, and it's more distress than Florida. It's more distress than most areas on the homeowner side, especially when there's any wildfire exposure. But it is not uninsurable. Now, there are lots of houses that I would say are in the hills that they're higher value, that are at some price they're insurable, but at a price that somebody wants to pay. Challenging to find that supply and demand balance where people want to pay the price it's going to take. That's tough. And the fair plan seems like it's going to keep growing. In most of the market, I mean, we would be willing to write 93% of the houses in California, again, on an E&S basis. And we think those prices are pretty reasonable for the risk that's involved. So
Yeah, what were those renewals like, Terry, on the in that Palisades sort of area? Like
yeah, I mean,
10 or more, 10%, 20%, 30%. I mean, I know it varies, but what would be
if
like a
you're
decent?
talking, if you're talking something where people, I mean, they would consider that extreme or very high wildfire risk, prices are more than double. And the reality is people are looking at, well, what did I have on an admitted basis that arguably was massively subsidized versus what can I get now? And it's unrecognizable. It's many multiples. What would we look at and say, what's the price before and after? A little more than double, generally. That's the market reaction to high wildfire risk. Across the state, we're not at double before and after, but we were charging on an E&S basis what we would have considered a more appropriate premium level. And so our before and after is a lot smaller than what you would see of what can you buy it today on new business versus what could you buy it. So agents that are seeing 3x, that's not going to be surprising. It's just,
Gotcha.
and it's not that I don't have empathy for the plight of both the homeowners living in California and dealing with it, but across the market, I think we were just dealing with a historically underpriced market for the prospective wildfire risk. If you look at it on the historical wildfire risk, you say, "Oh, why are you charging so much?" I believe, and SageSure believes, and certainly most of the market believes that the prospective wildfire risk is radically different than what we've seen historically, and you got to charge for that. I know our reinsurers think that. I know we think that. And so if you're going to take on the risk, you definitely have to get paid enough to believe that you can pay for your reinsurance and that you can have a little bit of profit left over to pay for your cost of capital. So it's a challenging market. It's one of the more distressed markets in the United States right now. But is it without coverage in the hills? Maybe really tough. But generally, and again, I use the number 93%. That's our proxy of, I think more than 90% of customers have a home at I'll call it a fair price. I'm not saying it's a price they like. I'm not saying it's not a much higher price than it used to be, but I would call that a fair price.
Got it. And then talk a little bit about on your underwriting side for your programs. sort of what your key advantage is. Are you using AI and are certain, things that are new to the industry to help kind of guide the underwriting and get, awesome markets, set for the agents?
Great question. So there's so much to this topic, and we can probably do a whole session just on this topic. I'll try to hit on the high points here. Our core underwriting appetite that we've had since inception in 2009, when we wrote our first policy in September of 2009, and today is very similar. It hasn't been radically overhauled by AI. The most important posture that we've had is we inspect everything. So we do at least a drive-by physical exterior inspection of most of our risk, generally coverage A up to, say, 650 or 750. We'll at least be physically present, and often with a drone inspection to make sure we can see the roof properly and so on, looking at tree coverage and that sort of thing. That has been our posture, and we believe if you don't get on site, you can't really look at it. Now, what has taken place in that is that journey has gone on. We've seen an increasing opportunity to use AI to augment things. For example, in the quoting journey, do I know this risk up front to reduce the friction post-bind when we're going and inspecting that risk? We want to find those things in advance and let the agent know, hey, we're trying to reduce that friction. You've got something here that we're not going to like. Let's let you know up front. So there's data sources that are, a lot of which are aerial imagery and AI driven, that are improving our quoting process through that journey. If we have an older roof that we think is going to be out of use within the next few years, that risk just isn't going to work for us. We're not that market. We're not a wholesale market. We're looking for preferred customers. And if that roof needs to be replaced and that's a claim waiting to happen, at a certain point, we're just going to get off that risk. So we're usually not going to stay on that risk in the underwriting period. And if a Cape Analytics can identify that from aerial imagery that it's running AI on, that's something that we want to avail ourselves of and think that's the kind of thing we're using it on the underwriting side. But reality is our underwriting is still mostly old school, which is we have somebody physically out there looking at the conditions and marking those conditions. And then we're running AI models on that and saying, these risks look like they need attention. And we are using AI for some of that. And we are running, our data science team is building models for that. And then saying, hey, somebody needs to look at this. And that's a human. We're not getting off a risk because some AI bot says we should get off this risk. We are using AI to detect, okay, this needs a look. So let's get a human looking at that to decide if we're going to stay on this risk. So that's where we are in that journey. Go ahead. You have a question?
Yeah, I was going to ask you. Yeah, so do you do that pre-inspection even before quoting, or?
No. That's all post-bind. That's
Okay.
all post-bind. And we would love to live in a world where we believed that we could get enough of that. And like I mentioned, like Cape Analytics use of roof age from detecting a series of images over time and saying, oh, clearly there was a new roof put on in this year. So therefore, this is the roof age of the structure, is an example of what you can do pre-bind. And we're using that, but it isn't good enough for all the attributes of a risk across every aspect, which are, arguably hundreds, but certainly dozens of highly relevant data points that you get from a physical inspection that at this point, there's no data vendor, no matter what data science model, no matter what their mechanism is, it's not enough data to meet our underwriting threshold. And we believe that has been the single biggest thing that has allowed us to grow to billions of dollars of premium is we have underwritten every single risk and allowed ourselves to stay on the forefront of knowing what risk we have and making sure we're getting paid enough to take that risk. So we believe ultimately that has been what has allowed us to get the capacity we need to keep growing in our underwriting track record of doing that. The organization has won Property Cat Underwriter of the Year for 3 years in a row. And we believe that is our, I don't know if I'd go so far as call it secret sauce, but it's our competitive differentiator that allows us to keep doing what we're doing.
Hey everybody, it's Eric. I just want to pop in for a quick announcement. Exciting news. I just launched my new book on Amazon. It's called The Blueprint, an insurance agency's unconventional rise to the top. And it goes through a little bit about how I built the agency Insured Solutions since 2009 to today. And the blueprint in terms of how I actually did it with the tech stack, the offshore, nearshore talent, and digital marketing techniques that I use. So pick up a copy today on Amazon. Thanks, guys. And then any advice for agents as far as trying to screen clients then, other than the roof? And how about brush, if it's fire exposure, what brush, close to the home?
Yeah, yeah. So most of that's a great question. And when you talk about wildfire in California, that is one aspect that we are able to do pre-bind. So our model about what we are generally willing and where our appetite is, that is built in pre-bind. So if it's a stream has a hazard, we know geographically where the risk is, and we know how we're thinking about brush. We certainly have maintenance expectations and clearance of the property that we prescribe in our guidelines. So, and those questions are asked in the underwriting process pre-bind.
That has to be done, would you say, prior to the, binding in this case? Because when you already know that area, you can't
That's
do
right.
it after binding then,
Yeah,
right?
yeah.
Okay.
For agents, the bigger challenge, which is harder to do, is what is the condition of the roof and how are the trees really a real threat? The quality of the trees and the condition, aerial imagery just can't do that for you yet. Will it someday? I don't know. Maybe they'll be able to detect the differences in a tree. I don't know. I'm not a data scientist and I'm not working on those models, but today it can't do that. So physical inspection is one of the mechanisms by which we're gathering data and ultimately saying that tree looks like a threat to the house. If it's a major threat to the house, that isn't going to be our claim that we're going to be on. So the tree is going to need to be maintained, in certain cases, unfortunately, taken down, or you're going to have to go to another insurer because in a lot of those cases, we believe the threat to the house is just too high. That's an example. So for a preferred risk at the price point, we focus on preferred risks and we want to offer a really sharp price point to the best customers. And the best customers maintain their property, make sure the trees aren't a threat to their house, maintain, their roof, get a new roof or get it repaired early and prevent it, doing preventative maintenance and maintaining their property generally. So we're looking for those kind of customers. We know there are a lot of other customers that don't meet that threshold and they need insurance too. They just tend to not come to SageSure. So for the agents that have that customer base that isn't, SageSure is not the home for what I'd say is the non-standard or the more difficult customer. We are the home for the preferred customer base, and our insurance distribution channels look a lot more like that.
And you
a lot
said
of your
you're in like 16 states, 10 miles inland is your focus, right? Right at the moment.
yeah, yeah. So our sweet spot has always been the middle to call it mass affluent customer. We're not competing with Chubb or Cincinnati Financial or AIG, or pure on the high value stuff. That's not our game. Our game, we will start in the low end of looking for a house, maybe 200,000, depending on the state, maybe 300,000. Our average customer is about $500,000 replacement cost, all the way up. And in certain cases, we'll do up to 3 or 5 million, but that's not our main, our real focus is in the middle market portion of homeowners. And so for your commercial agents who are running into those risks, we're certainly relevant for the preferred customer, and many of them, they may have a replacement cost of $800,000 or $900,000. We're certainly, we believe, a great market for that type of risk if the customer has a good credit profile, has clean loss history, has a newer house or a newer roof. That's the customer we're looking for, and I think a lot of the commercial audience who is running into, their commercial audience where is that person getting their home insured? We're a great market for that in catastrophe prone areas.
How would you compete then with the agent's current markets in that preferred area, the preferred, the price range you just mentioned? Who are you beating quite often in that area?
Yeah, if you've got a preferred customer, it's rare that the things I described, it is rare that if you have the best credit profile, you've got a clean loss history, you've got a new roof on your house, and you're at $900,000 of coverage A, it's rare that somebody's beating us. On that point, we close nearly half of the time. Because so I mean we're meaning we're the best market for that in catastrophe exposed areas. Sure, there are competitors and they beat us on a lot of stuff, but on the best risks, it's rare that competitors are beating us.
And you said your top markets now, I believe, were Texas, Louisiana, New York at the moment, the top three.
That's right. Yeah, especially in Texas, Louisiana, increasingly California on an E&S basis. Sure, if they get a quote from, say, a USAA direct consumer, that might beat us out. And a great organization offering very sharp price points to their membership. But if you're looking at it on a independent agency market basis, and you're not getting a quote from most of those admitted markets who are shut down or unable, that's where we're winning most of the time. So yeah, Texas, Louisiana, we're doing a lot of that in Florida on an E&S basis, especially because a lot of the, maybe at a million or a million one, there's a lot of admitted markets that just aren't playing there, or they aren't wide open for new business. So we're winning markets like that. Coastal South Carolina for sure is a huge market. We're one of the largest market share players along the coast in coastal South Carolina, certainly writing more new business than most, if not all, of the rest of the market. So there's a number of markets where those are big for us. We like coastal North Carolina, New York. You mentioned, yeah, New York's a big state for us. So those are the kinds of markets where we do very well, where there's a concentration of population in very hurricane exposed or in California wildfire exposed regions. That's where we do very well.
And you think agents are making headway in terms of these folks that are in the high risk areas, getting them to understand what they're going to need to do with the roof, with the maintenance, to, get their premium back in line, so to speak?
Yeah, I absolutely do. I mean, I think that's the natural cycle of it all. Um, in the last few years, in a lot of cases, people are telling us, you are our only market in Houston. Now, we know that's not true anymore. There are, I mean, Travelers and Safeco are coming back a little bit in the Texas area, maybe not Houston proper, but certainly in the outskirts in Austin, San Antonio area. And you're seeing other players come back into the market. So we're not alone anymore, but we've been there. We've been through thick and thin with a lot of these agents, and so we're certainly on their top few. And so we're in the market, and homeowners themselves are learning. Look, I got to maintain my house. I'm going to have a higher deductible, and those that have pride of ownership, I think they're taking care of their house more, and they know they've got a stake in the game. They've got a 2%, in some case 3 or 4 or 5% deductible, and they want to take care of their house. They don't want to have a loss and have to pay that deductible. So I think you're seeing the customers at large, certainly on the preferred side, come around and realize it's a very different game than what the insurance market looked like in 2019.
Got you. And like, talk about your program structure. Like, yeah, I think you said you did have a few wholesale markets, but what's your, is it by state as far as how things are set, or, is there one big program? Like, I know more about on the work comp side, so you have to kind of educate me about structure on the admitted.
Yeah, I mean, we have our whole business plan has been to provide a bunch of different options and make sure that through various distribution sources, we're able to supply what people need. So we have multiple AM Best A or A minus rated carriers who are supplying capacity. Now, of course, they're going to be more expensive than Demotech rated. I know you're on the workers' comp state, so you probably don't see much of the Demotech or the different rating agencies.
Yeah,
But Demotech has been around.
yeah, a lot of the E&O won't cover it for the care for P&C agencies. So, but
Well,
personal lines, I'm sure it would.
it does in the personal line side, and Demotech has, having been around for several decades, they have worked that away. So maybe with some commercial agencies, they've never availed themselves of the provisions, but generally, is not hard to get a hold of at all for agents that are writing personal lines. And Demotech is, companies who are rated A by Demotech are increasingly relevant in these coastal property markets. So,
Absolutely.
and it's increasingly relevant in California. So companies that are rated A by Demotech generally are not fly-by-night operations. Certainly, there have been organizations that haven't been as solvent as we would like to see, and we've seen some of those, most notably in Florida, but we saw some in Louisiana as well over the last 5 years. But generally, there are way more demotech companies that are operating and providing capacity in these coastal areas. So independent agents are using them, and you at least need to know what your competition is. So if you're a commercial agent and you're running into AM Best from a SageSure perspective, we got your back. We have AM Best A-rated options in all of our markets. So we're not saying you have to write demotech, but we are offering demotech options, and the price difference is generally meaningful. And so
You got to
that's
look at it.
that's the reality of choice. And so we believe it's got to be the choice of the customer and the choice of the independent agent who's selling the product. What do you want to sell? And if you believe you need to sell the AM Best option, we have it. But in almost all cases, it's going to be a little bit more expensive.
So back to the program question. So you're handling underwriting, you're handling submissions, you're handling the
Claims.
claim. You will handle claims for all programs, or
Yep.
okay.
Yep.
And so, and has that experience been, a winner, for the client?
Yeah. I mean, claims is a great topic and a long one. I describe that as the biggest mistake we made starting this organization. In 2009, I don't think we had any choice to get into claims, and we were just starting up. But along the way, we didn't start getting into the claims settlement process until 2020. So we had a massive ramp up. We've invested tens of millions of dollars of fixed costs in building out what we believe now is one of the best claims operations in the business. We've invested a huge amount in technology, a huge amount in all facets of settling property claims, and very lucky to have brought in Kat Reese, who she worked previously in a senior claims role at USA, and then she ran the claims operation at Tower Hill, the Florida property carrier. So she leads our claims operation, and we've made huge investments there to build out a great operation. It's a challenge. Excuse me. It's a challenging business. I'd say at the core of it, the experience has been great. We have found the right balance, I believe, of making sure the customer is always taken care of and get their claim settled properly, while pushing back on excessive contractor margin. So not to the detriment of the customer and shortchanging the customer. We have heard story after story from carriers who take shortcuts and are really trying to shortchange the customer, and we just don't take that approach at all and don't believe you can run a business that way successfully in the long term. So we take care of our customers. We make sure they get things settled properly, but we really do work on the contractor margin. I'll just offer one tidbit there on how we do that. One of the things that we do, for example, on roofing, is we use a company called Roof Marketplace, which provides 3 competitive bids and really reduces the contractor margin by introducing a competitive bidding process across roofing that we need to do. And so in that process, we make sure that the contractors stay honest on how much margin that we're going to put in there. And we've had really on the ground actual cases where the same roofing company, one through a salesperson, comes out and bids on the house, talking to the homeowner, and then one going to the same roofing contractor with better materials than this company bid and getting a $25,000 quote from that same company versus a $36,000 quote from that same roofing company. So there are real examples of where contractor margin is the only difference. It's not the quality of workmanship. It's not the quality of what the customer ultimately gets. It's a margin issue. And so pushing down that margin, not to the detriment of the customer, but in fairness to the ultimate process, the contractor's got to make money. But the question is, how much are they going to make in margin? And we want to make sure that gets to a fair level. So that is an example of how we built out claims capabilities. There are many more examples. I don't want to hijack the entire conversation, but the pool is pretty deep there. And that's certainly one of the most important topics we talked about in our global reinsurance visits. We do more than $2 billion of catastrophe bond sponsorships globally. We buy billions of dollars of additional traditional reinsurance. So the biggest part of what SageSure does in making sure that our customers are ultimately secured is buy billions of dollars of reinsurance and cat bonds to make sure we can keep up with our promises, our reinsurers want to hear, how are you really settling these claims? And people can make great promises. Oh, we all use all these TPAs. If you don't do it yourself, it's very hard to control the claims costs. So we do it ourselves. Of course, we rely on TPAs in CAT scenarios, but we have a 150-person claim staff that we rely upon to do a lot of our everyday claims and be ready for the big catastrophe events, both internally as well as in the field. So
Well, that's impressive, 150 people. What about the site visit? Is that a service you use or third party?
yeah, we do use third parties. Importantly, though, we only use third parties that have good enough technology that plug into ours. So all of our inspecting is done via technology that integrates with our inspection partners. One, you talked about AI earlier as an example. When those inspections get done, I mentioned you have to get the data back and you have to get the images back all electronically, and our models are run against that to say, where does this go? Do I have an issue here? Does an underwriter need to look at this? Is this file clean? And a lot of that obviously has to happen programmatically with models and with automation. Although, I mean, because we do 250,000 on-site inspections a year, that kind of volume can't be done with just humans. So we're running models against that, and we are using vendors to be the humans that are out there inspecting the site. In some cases, they're drone inspections. Some cases, they're more old school physical measurement. But clearly, over time, that's going to be going increasingly to drone or aerial imagery type inspections. But we're not there yet. We're physically on site with either a drone inspection or a physical person today, but we're using 4 different inspection vendor partners.
That's fantastic. And then what about the quoting process? Is there like a portal you're providing for the agent to use to get quotes?
Yes. SageSure's agent portal is something we've invested. We're either at or above 9 figures of investment. I believe our investment has been over $100 million in that platform over our journey. It's a massive part of what we believe helps us win. We talk about underwriting on the carrier side. Of course, on the distribution side, if you don't have the best quoting experience, you're not going to keep your agents interested. They're going to go elsewhere if it's smoother. So that's been a huge area of focus. It's entirely proprietary. We do not use off-the-shelf technology. We don't believe that you can use a off-the-shelf platform as your core quoting and binding engine and really win the business and win the hearts and minds of your distribution. So it is a highly differentiated. And for those agents that are out there, about 70% of our agents, we do massive market research using third-party research firms to make sure we know what our producers feel about us. And the agents that are writing with us, 70% of them say we are either the best or one of the best quoting experiences that they have on their desktop. So our goal has always been that more than 50% of our distribution thinks of us as the single best quoting experience they have in their agency. So certainly on the homeowner side, we are winning on that, and we spent enough money, I hope so, but certainly that is an area of differentiation for us.
P&C agents, have you run into Byberg, which is a Berkshire Hathaway company quoting workers' comp for either your prospects or clients? Well, great news. Insurance Solutions, a national MGA, has an appointment that is set up to allow you to quote, bind, and service Byberg at your agency. And the coverage is in all states. It's A-rated. Startups are even accepted. There's $125,000 maximum premium. And some of the tough industries they write are construction, transportation, that includes towing and parcel delivery, manufacturing, security guards that are armed and unarmed, motor mediation, and many more. So go to our website at insurancesolutions.net, click the Get Appointed link. We'll get you logins for you and your team, and can set up a webinar for training if you'd like. Also, feel free to email info@insurancesolutions.net, and I can handle the submission myself, or call 770-402-5343. Be glad to speak to you and give you more detail. Thanks. That sounds good. And then if you're trying to focus then on a market, let's say, wanting to expand your personal lines area, like what would you recommend in terms of types of I don't know, risk and or areas to focus on?
Yeah, well, I mean, SageSure, as I mentioned earlier, we focus on preferred customers. So our view is your preferred customer, which I would think in a lot of cases correlates to, a small business owner or a professional that's doing well, somebody that is preferred. Now, preferred is not limited to professionals or small business owners. There are many very responsible, hardworking people that have good credit scores, have clean loss history, have a new house, and maintain their house very well. So, whatever that profile of what we would refer to as a preferred customer, and I gave the three most important statistics there. And of course, I think we know financial responsibility and responsibility for a well-maintained dwelling. For us, those are the customers. Those customers tend to want to buy insurance and focus on living their lives and not focus on shopping insurance every year. They also tend to get better prices. We certainly price them better, and they generally get better prices. They stay with your agency longer. They stay with your carriers longer. They take less work. And those are the best customers. Those are the ones you want to go after. I think for all the agents out there, their customers, I mean, their competitors are also probably going after the same customers. So the question is, how do you get a hold of those customers? I don't know that side of the business. That's why we rely on agents, and we do all of our business with agents. We don't do any direct consumer. That's not our business model, nor do we plan for it to be our business model. We partner with agents that know how to get those customers. So whatever the modern ways or the old school ways you acquire those customers, my recommendation is go after those customers. Those are the customers that we're going to be able to provide capacity for, even in the most difficult markets like
Yeah,
the
that's what I'm
catastrophe.
thinking. Yeah, so like to get the higher premiums at least, preferred customer in the difficult market is the goal, right?
That's right. That's right.
And you have to know your stuff to be able to talk that client through to make sure they're on track or have already done the work, to get the right pricing.
You, you've got to know your stuff. And the other recommendation I would make on the agency side, if you're going to sell that customer, if you're going to go to a preferred market like a SageSure, or I would say if Travelers was open, it would be a market like Travelers. Um, and if American Strategic is run the way it was, and Progressive was run the way, those kind of organizations, they're going to underwrite the risk. So don't try to play it fast and loose. Ensure that property to value, which is what the customer ultimately wants. Explain to the customer it's in their best interest to insure it to value. Explain to the customer that they should take care of their house. If it needs a new roof, get a new roof. And if you take care of your house and you maintain your property, then the insurance should take care of itself. And so my recommendation is go after those customers that believe that and make sure you educate them on the importance of that. And if they're not looking for that, they're looking for something cheap, they're looking for just bottom of the barrel price, that may not be the right customer for your agency. You can get them insurance and maybe go to a wholesale market for that. If they have an older roof and they don't want to replace it, there are markets for that. And we actually have some of those markets, but that's not the core customer that's going to stick with you long term. That's not the core customer that is going to be your best customer for a long time.
That makes sense. Well, Ted, this has been pretty good, man. I've learned a lot. Just like I said, I'm not knowing this side of the house as much as I need to or should. But if somebody wanted to get in touch with you directly to ask questions or get set up, if they're not set up with Sage Insure, what's the best way to reach you?
Yeah, well, we can certainly reach our website. We have a broad sales staff. We have about 50 salespeople. We have a pretty large go-to-market profile and organization. So there's plenty of people to reach out to. If you're really coming into it cold and you need SageSure appointment, if you go to our website, SageSure.com, you'll be able to see the contact form where you can connect to us to seek an appointment. And certainly we're always looking for more distribution. So we're happy to help out.
That's great. No, this has been a good learning experience. So I appreciate you coming on the time and looking forward to hearing back to see what some of the comments are, from our agency networks as well.
Sounds great. Well, I really appreciate it, Eric. It's great to be with you.
Thanks, Terry. Thanks again for tuning in to Insurance Shop Talk. If you enjoyed our deep dive into the latest trends, Please don't forget to like, subscribe, and hit the notification bell so you never miss an episode. Until next time, I'm Eric Stein, and this has been Insurance Shop Talk.